Over the past few years, real estate investors have been navigating one of the most uncertain markets in decades. Interest rates surged, deal flow slowed, financing tightened, and a lot of investors simply hit pause, waiting for the market to stabilize. But while many investors were sitting on the sidelines, trying to predict what would happen next, today's guest took a very different approach. Justin Spillers, a former real estate attorney who left the legal world to become a full-time investor. He's built a portfolio of over 700 apartment units and more than $65 million in assets, primarily in multifamily properties across Ohio. And here's the interesting part. While many investors struggled through the post-2022 downturn, Justin wasn't trying to predict interest rates or time the market. Instead, he built a system designed to win regardless of what the market does. His strategy is centered around something most investors overlook: operational control and speed. By vertically integrating every part of his business, from acquisitions, property management, construction, and leasing, his team can renovate and release apartment units in as little as 7 days compared to the 60 to 90 days that many operators take. That speed allows him to force appreciation, refinance properties quickly, and recycle capital far faster than most investors. In this conversation, we talk about how he weathered the real estate downturn after 2022, why he's still bullish on multifamily in today's environment, the real risks facing investors with interest rates, tariffs, and geopolitics, and the exact investment philosophy that helped him scale to hundreds of units. If you've been wondering how to invest in uncertain markets or how professional operators actually build scalable real estate portfolios, this episode will give you a behind-the-scenes look at how it really works. So let's dive in. This is my conversation with Justin Spillers. Welcome to another episode of the Financial Freedom Podcast. Justin Spillers on the show today. He's a real estate investor, a former attorney turned investor. He's got 700 units managed and 65 million plus in assets. He's here to talk about real estate investing, more importantly in the geopolitical landscape, interest rates, Trump, tariffs. Justin, welcome.
Appreciate that. Excited to be on.
Introduce yourself and we will dive into the questions.
Justin Spillers, a business partner, Brandon and I, we own an Ohio multifamily value add portfolio of 700 apartments, all in Western Ohio, fully vertically integrated, have a team of 50. Bought our first property in 2016, grown it to 700 units today. Self-funded to date, created a preferred equity fund last year to raise additional capital to supplement our own. I'm a former attorney by trade, went to law school, practiced real estate law for 7 years, left the practice in 2016 to start my own companies.
Real estate's been in a slump since about 2022. What was your strategy for surviving this downturn?
We inadvertently exited 200 units in 2021. Good timing in hindsight. Not that we tried to time the market. It's just when our full value add models were done. We're value add investors. We buy, renovate the units, increase top line revenue, NOI, and then sell. Now we're renovating, refinancing, and long-term holders. In 2022, we didn't find much good deal flow, so we didn't buy anything. In 2023, we found a really good off-market deal we bought, and that started a purchasing spree. We bought 500 units from 2023 to end of 2024. All have been really good purchases for us. We've been buying ever since. It didn't hit us hard because that year we didn't find anything to buy. We were busy operating our existing portfolio. We got lucky, weathered the storm. We didn't have to place capital. We were using all of our own capital. We were doing everything in-house. We didn't have that big push to find that next deal or deploy capital. Conveniently missed that hit in the real estate market.
When you say 65 million plus in assets and 700 units managed, delve more into your investment strategy.
Completely value add. We only buy in Ohio, about 20,000 multifamily properties in Ohio. About 4,000 fit my buy box, which is 30 to 300 units, out-of-state owners, mom and pop owners, someone who hasn't improved the property in 10 years. We come and buy it, do heavy CapEx renovation project, increase rents $200 to $400 per door as fast as we can, do everything in-house, including the value add turns, refinance and get our capital back. We underwrite about 100 deals per month, 1,200 per year. I only buy a couple of properties per year. I'm hunting for those needle in a haystack home run deals. The biggest driver for us, we have a very elaborate underwriting model. We've underwritten thousands and thousands of deals. All I care about now is how quickly I can get my capital back on our CapEx spend. For example, if we put $3 million into a deal, I want to be able to refinance it out and get all that $3 million back as fast as possible. We underwrite to being able to do that in about 18 months. A very unique metric. It's mostly driven by CapEx spend, being able to create forced appreciation as fast as we can in that model. We try to target for every dollar of CapEx spend, we want to get $3 to $4 of value.
You're raising capital and fundraising in today's market. Who are the people that pull together to give you money?
We don't syndicate. When I was a real estate attorney, I used to build syndications funds. I saw the good, bad, and the ugly. I hated the guesswork, IRRs, third-party risks, very little skin in the game, the long-term lockups on the capitals. We created a preferred equity fund to solve that. When you invest with us, it's liquid. After the first 12 months, you can get some or all your money back at any time with 90 days notice. Second, we give a fixed 12% return. It's not a targeted IRR and aspiration number. It's a true fixed 12. We paid out every single year on December 31st. Our investors have two options. They can reinvest it or they can take the 12% payout. If they take the 12%, it's not taxed until year 9. So it's like an after-tax 12%. It's pretty unique. And the best part is they invest in that preferred equity spot. Banks get paid first. Investors get paid second. Then me and Brandon, we own all the common equity. So we get paid last. So they're there, super safe spot. They invest into our entire portfolio as an open-ended evergreen fund. They get exposure to our entire existing 700 units, plus all future purchases. It's a unique spot they come into. We target retail investors, typically professionals, doctors, attorneys who have excess cash flow, looking for that good double-digit return without getting any taxable gain, with a lot of optionality to get the capital back if they need it to buy a new house or buy a business. That's our sweet spot of retail investors, mostly professionals, high income earners.
Before we talk about the success stories and lessons learned geopolitically, how are you positioning yourself with the exit of Powell and the oncoming of Kevin Warsh in May?
The velocity of which we put capital to work and how fast we grow, 1 or 2 interest points doesn't impact our model whatsoever. Speed is our differentiator to blast through the interest rate risk. We are hyper-focused on it. When we go in and buy a deal, we get 5 or 7 year fixed adjustable rate mortgages on the front end from our purchase loans from our regional banks. Then we refinance out into long-term agency debt, 10-year fixed, 30-year amortization, typically sub 6% interest. My entire cap stack, I have about $38 million of lender debt. It's all fixed roughly at 6.5% for 5, 7, or 10 years. I have very little interest rate risk. Then the preferred equity fund, we raised $4 million so far. That's fixed at 12. So my blended cost of capital is about 7%. It's fixed. I have very little risk to that. Obviously, I'm cheering for the interest rate drops like everybody else, but it doesn't impact our business model to the sense it would have for a lot of stabilized guys.
You alluded to, hopefully we're predicting the interest rates will go down. Moving forward, how are you looking at the real estate market in 2026? Is it going to still slump, bullish, or teetering along?
I went to NMHC, the largest multifamily conference in the country in Las Vegas a couple of weeks ago. There was mixed. I saw a lot of optimism from one half and pessimism from the other half. It was a tough read, but in our market in Ohio, deal flow has been very strong. We have a very large acquisitions team. We do a lot of deals regardless. We have a lot of LOIs out. I have a lot of optimism. We're going to be closing on a lot of units here first Q1 and early Q2. It's been really good for us on the value add side. There's a lot of out-of-state owners looking to exit, a lot of older mom and pop owners that are starting to think about retirement that are exiting. It's a volume game. If deal flow slows, you have to find off-market deals, being more aggressive on the acquisition side. I'm bullish on it, especially in Ohio. There's going to be a lot of transactions in my class, the B and C class market. I don't have a great pulse for the luxury market, the A class. I think there's a lot of interest rate risk there that will cause turnover in ownership, but I'm very optimistic on the real estate market for what we're doing.
Quick pause here. If this episode is making you rethink how your income is structured, that's intentional. Information doesn't create freedom, structure does. At the end of this episode, I'm going to show you how to diagnose whether you're building leverage or just scaling complexity. Let's get back into it. You alluded to insulating yourself from interest rates. How about risks you see for real estate with Trump, tariffs, equity markets, gold, silver, and Bitcoin?
Yeah, Trump, obviously, he's a big real estate guy. He's passed and continued to reinforce all the great tax benefits for real estate investors. That's been great. There's no negative risks there from the big picture business thesis of real estate investments. the 1031 exchange, we have bonus depreciation, cost segregation. There's a lot of really good levers to pull. That's been great. Tariffs, cost of goods on our turn. So we don't build new, we're not in new construction. That impacts them significantly more than us. Cost of our turns have gone up 20, 30%. Not so much that the amount we've been able to increase leases can't keep up with it. We've been really good at increasing rents to keep up with cost of construction on our value add side. That's not been too bad. Obviously, stability there would help, but the chaos has created market opportunities. It hasn't hurt it too bad. On the last bigger piece of the other hard assets, I view all that speculative. It's a hedge against fiat currency. It's a hedge against the equity markets. I love real estate. I can touch it. I can feel it. I can control it. My properties are in my backyards. I can go and operate them. In a true doomsday scenario, I could let go of 90% of my staff. Me, Brandon, my top team members, we could stabilize our properties, cash flow. We want to be doing the value add, but I could keep everyone paid and do very well. I love that aspect of it. Gold, silver, Bitcoin, it's the Wild West. You get one company that's completely taken over the market, whether that's Blackstone or whoever, they can create artificially dips and peaks. They're the ones that always make the money. The retail guys like us, we're always behind the eight ball. I don't like investing in assets I can't control for that reason. Heavily bullish on the real estate market because it is controllable and because of all the tax benefits.
Moving on to your funds, if someone were positioning themselves to capitalize on real estate, either single family, multifamily, how should they be thinking and how can you help them?
If you want to do it on your own, I highly recommend it. One great thing is that you get the depreciation, right? You get all the benefits of the losses, offset your income. A lot of people, they'll get tripped up. If you're doing it part-time and you're not what's considered to be a real estate professional, which is a legally defined term, you got to work 750 hours. That has to be the bulk of your income. You can't offset like being a doctor with your rental property. Everyone thinks you can do that, but you can't. Make sure you understand the benefits and if it actually works in your situation. Your spouse can, though. That's a very common thing to do. It is great. It's a great place to put money. Real estate appreciates, cash flows extremely well. It's an asset class I think people should explore if they have any level of interest. It's a great investment vehicle long-term. I'd say the first step, invest with somebody, whether it is a syndication of the group in a single asset, you invest with us in a large portfolio or fund, you get exposure by osmosis of seeing what we do, how we do it, what matters. You start to learn the terminology. You need to understand the foundation, the basic metrics of real estate investing. Get some books, start watching, start reading. The world seems very big in the real estate space. A lot of concepts, very complex. As you learn, it gets very small. Everything boiled down to simple concepts. Once you have the basics down, you can do it on your own. I always recommend doing your due diligence, finding a really good operator, place a little bit of investment, grow it, and learn. I have 25 retail investors. I'll take any phone call. I'll answer any questions. If they have their own flips they want to do, their own investments, I'm happy to look at it. I'm a great resource. I have 10 years of experience. I've seen it all. So rely upon other people in the space. Reach out to them. If you're an investor with them, they have obligations to you. Not that I wouldn't help someone regardless if they invested with me or not, but that's a great way to get into it.
With all investments with firms, it's all about the fit. What differentiates real estate alpha, the defining characteristics that make people invest with you over others?
Two big things. First, we do overown acquisitions in-house. I have an acquisitions manager, 3 analysts. All we do is underwrite those 4,000 properties that fit my buy box. I am hyper-focused on buying. You avoid a lot of mistakes by buying right. We create value by buying right, finding good off-market deals. Second, and most importantly, we are fully vertically integrated. I don't outsource any part of my business. I don't leave anything to guesswork. I do all my own property management, all my own leasing, all my own maintenance, all my own construction in-house with the sole focus of speed. We want to be able to turn the entire apartment complex in 18 months or less, 2 to 3 times faster than most of our competition. We do it by being vigilant on our scheduling. When one of our tenants gives us a move out notice, my leasing manager's in there the next day. There's a full video inspection, gets it to my turn team. We figure out which turn type we're doing. We have 95% standardization. We do the exact same LVP, floor, paint, trim, cabinet, countertop, bath fixtures, appliances in every turn. We do it in 7 days or less using our 3-man crews. They work 10-hour shifts. My painters work at night. My leasing team has a pre-lease sign and new tenants moving on day 8. That fully vertically integrated stack, being able to turn full units in 7 days or less. My competition's turning it in 60 to 90 days. Being able to do it for half the cost, that is the differentiator. We do that extremely well. And that allows us to use our capital much quicker, refi the velocity of cash we can put it to work much faster too. I don't need crazy outlandish returns over a 4-year period because I'm realizing all the gain in an 18-month period. But it allows our underwriting to get even wider in the deals that look really good to us.
What are success stories to conclude?
With us, you know your success story in the front end. You get that great fixed 12%. You get to take the distributions every year without paying any tax on it. If you invest $100,000, for example, I'd pay you $12,000 every year. You can spend it, redeploy it. There's no gain on it till year 9. If you need your capital back for some reason, you can get it all back by giving us 90 days notice. Then you're in that super safe spot in the capital stack right after the banks. I'd have to lose all my value first. All of our investors have had the exact same returns and a really safe risk adjusted spot with the optionality of putting their money to work with us, adding to it, reinvesting it, taking the distributions, or getting it all back at their own option. They've all had a great experience so far. We've never lost anybody's capital. We've given that really good return. At 12%, you double your money every 6 years with no tax. It's a really safe play. It's a really good upfront cash on cash return for them to use.
How can people connect with you and learn more?
realestatealpha.io is our website. If you look me up, Justin Spillers, Real Estate Alpha, you'll find my LinkedIn profile, my email, phone number, everything's there. Reach out. I'm happy to help with any questions anytime.
Excellent. Thanks so much for coming on and talking to us about Real Estate Alpha. We really appreciate it.
Yeah, thanks so much for having me.
Let's zoom out. If you're a physician, founder, or high-income professional, and you feel like you're working harder every year, but not structurally freer, you're not alone. The mistake isn't effort, it's architecture. This show exists to help you convert expertise into scalable leverage, faster and with fewer expensive missteps. Here's the diagnostic I mentioned before. If your income requires your constant presence, if your capital isn't compounding outside your profession, if your highest value talent is doing low value tasks, you don't have a growth problem, you have a leverage design problem. And if you want to fix it with clarity instead of guesswork, I offer a limited number of one-on-one leverage strategy sessions each month. We audit your income model, capital deployment, authority positioning, and structural bottlenecks, and design your highest return move. If you're serious about compressing years into months, the link to apply is below.